Amortization, mortgage terms, GDS, TDS, open, variable, closed, fixed, closing costs, down payment. All these are the terms that you will encounter when you get your next mortgage. In this episode, we're going to go a little bit deeper and expand on this. So stay tuned. This is episode number 3 of Lucid Property Advice. Now let's get to it. If this is your first episode you're watching, I highly suggest you start with number 1 because it's a complete series. We're going to go from start all the way to the end. So let's start from number 1. But this is episode number 3 and you're welcome to be here and continue watching. So today we're talking about mortgage terms and we're going to start with amortization. So amortization is the length of time that it will take for you to repay the whole mortgage back. And on average is 25 years. So meaning you would have to make 25 years of payments, so monthly payments for 25 years to pay it off. But if you keep watching our episodes, we're gonna go a little bit more in depth of how we can reduce these amortization to pay off the mortgage faster, because I think nobody wants to take 25 years to pay it all back. But in very general terms, amortization is the amount of time it's gonna take for you to pay the whole mortgage back. Next term, we're gonna go into mortgage term. So mortgage term is also a length of time that the mortgage contract conditions and the interest rate is fixed. So meaning, so mortgage term, so amortization, you have 25 years, but in those 25 years, the bank will do up to 5-10 years of terms, meaning every 5 years, if you take a 5-year term or 10-year term, there's 10-year terms. Every time you take those terms, after that, you're subject to renewal. So meaning if the rate has dropped, you could take advantage of that lower rate. If the rate has increased, then unfortunately it's going to be passed on to you. Now you have to pay a little bit more interest rate. But that's basically to make sure when the time comes for renewal, if there's any missed payments, if your credit score has gone down, the bank can choose not to renew your mortgage, and that's where things get tricky, and now we have to get you to another bank for you to continue paying off your mortgage. So mortgage term is usually a subsection of a time where if you take a fixed interest, the interest will be fixed for that time, and then that will get renewed after each term for you to renegotiate your interest rate. Sometimes you could take some equity out, so it's all both ways. So at that time is a good way to take some equity out because you're gonna be avoiding penalties if you break the mortgage. So it works both ways. So a good tip I can give you, what I see a lot is before you take a term, you have to make sure, if you take for example next time 5-year term, you have to make sure in those 5-year terms you're not going to be in a situation where you might have to break the mortgage. If you think you're going to break the mortgage, or for example, let's say if you're going to sell the house in 3 years and move into something bigger, it makes no sense to take a 5-year term. Maybe take a 2-year term, maybe take a 3-year term, to make sure that you don't incur any extra penalties when it comes down to selling or renewing or refinancing. We're gonna move on to GDS, gross debt service. It's a ratio that us mortgage agents and brokers use. It's basically to calculate your mortgage affordability. So there is a certain criteria you have to stay below to make sure you qualify for those amazing low rates that you see. So it's basically will calculate your affordability, but there's GDS and TDS. So we'll talk about TDS next, but let's talk about GDS right now. So GDS includes in the ratio your mortgage payment, is going to include your taxes, so your property taxes, your heat, and 50% of your condo fee. So if you live in a condominium or condo style townhouses where you have these monthly obligations, to pay, that you pay the condo community and the condo services, we take 50% of that and we divide that by your total gross income. And that ratio we get is what we have to use and work with that to kind of get you qualified So again, I'll repeat it again. It's going to be your mortgage payment, it's going to be your property tax, your heat, and 50% of your condo fees. I just want to say another thing. Condo fees is 50%. Is good, and condos also have their advantages and disadvantages. Like, for example, in one of the condo houses that we own, you don't have to pick up the snow, cut the grass, or anything like that. So that gets taken care of. So that's a pretty good way of looking at that as well. But because these are monthly obligation, in terms of owning the property, we have to include that, but it's only 50%. So that's great. Let's talk about TDS. TDS is total debt service. So it's very similar to GDS, but it includes more things. So these include the total debt service. So not only we take the sum of GDS, which was going to be, your mortgage payment, your property tax, your heat, and 50% in condo fee, plus now we add all the other liabilities that you are liable to pay. So those could be credit cards, student loans, car loans, line of credit loans, any kind of liability you have. And that we include your monthly payments, and then we divide it by your gross income to come up with that ratio. So those two ratios, so obviously one is going to be higher than the other, but they both have a limit they have to stay under for you to qualify for those low rates that you see out there. So you have to keep that in mind to keep your debt low. When you're looking for a house, it really helps you qualify for those good rates, and obviously it helps you qualify for mortgages. And the reason I say low rates, meaning there are ways to still qualify when you go above the thresholds, but that is high risk area, and that high risk is passed on to you through a higher interest rate. So just keep that in mind as well. So there are ways, that's why we're here to help you out in whatever your situation is, but you have to keep in mind that if the risk goes up, it's going to be passed on to you through interest rates, right? So because now you're not only you gotta make that monthly mortgage payments, but we also have to take account of these other monthly credit card payments and loan payments, and now now the gap is much huge, and we got to make sure if your income covers it, now you only have this much room to have your other costs, like there's your cost of doctor costs, school cost, and everyday expenses costs, your food, your grocery, your cell phone, stuff like that. We have to keep that all in account. So just something for you to think about. And we're gonna go over next to something called LTV. So that's loan to value. So loan to value is a percentage, shows how much loan is being taken. So for example, at 80% LTV on $100,000 would mean the borrower is putting down 20% down. So I'll say it again. So on an 80% LTV, so 80% loan to value on $100,000 would mean that the borrower is putting 20% down, which would equal to $20,000 as an example. So if you're saying, if you're putting down 20%, for us mortgage broker, we're gonna see it opposite. We're gonna say it's 80% loan to value, because if the loan is 100% and you're putting 20% down already, now technically you need loan for the 80%, right? So $100,000, you're putting 20% down, which is $20,000. Now you need loan for the $80,000 that's remaining. So LTV is loan to value. It's a very simple calculation. It just basically means how much down payment you're putting down versus how much loan you're taking out. Another key point I want to put down is when you're putting 5% down payment, so 95% LTV. Number one, 5% is only for the first $500,000, and it's 10% for the remaining amount over that. So meaning if the house is $600,000 you're buying, that doesn't mean you have to put 5%. It's going to be a little bit more, because it's going to be 5% of $500,000 and 10% of $100,000 equaling to the $600,000 purchasing price. So that's something you got to keep in mind when you're calculating how much down payment you need. You know, I see a lot of people out there trying to figure this mortgage thing out by themselves. Hopefully this helps, but it's always good to reach out to a professional and let him work the numbers, so you know you're safe and you're not getting misguided by a lot of this information that's out there, right? Too much information is bad as well. That, you know, if you don't know how to condense it and filter it to take what you need and what you don't need. Okay, so we're gonna move on to something called closing cost. So a lot of people just think about down payment, they don't really think about closing costs, right? So down payment is one thing, 100%, but how about the other costs? There's land transfer taxes, there's lawyer fees, there could be appraisal fee, right? We might have to pay some debt off. Like we have to make sure not only you have your down payment money there, but you also need to have a closing cost. So closing cost is the cost in addition to the purchase price of the home that are gonna be paid on the closing date. So usually at the lawyer's office. So a very quick calculation that we like to use is about 1.5% of your purchase price to have that much money to the side, and that just makes the bank comfortable that they go through night and day to get you that mortgage commitment, and they want to make sure that they give you a mortgage commitment and they can actually close it in the end at the lawyer's office, meaning that you could pay out the property tax, you could pay out the lawyer, and you could pay out for the appraisal to make sure you can close that deal in the end. So 1 to 1.5% you would need for closing costs. So just as another cost that people tend to overlook, so just make sure we keep that to the side. So for example, if you have $50,000, you have to make sure how much that is going to be in the down payment and how much closing costs you're going to have left over in the end. So just something to keep in mind. So we're going to move over to down payment. Down payment, everybody knows down payment. It's a portion of the home purchase price that is not financed through the lender. So it's just basically, it's your part of the commitment to put down that you're serious about buying it. It's very similar to a deposit that you put down when you're buying a house. It just means you're committed. It means you have the ability to save money. It means a lot of things, because you have to understand, to have down payment, that means you've been saving money. To save money, that means you're managing your expenses, right? So having a down payment explains a lot about the character. There's a lot of things you need to understand about the down payment, how it can come and how it cannot come. There's a lot of money if you have back home and you want to sell that property, bring it over. There are some ways you could do it quicker. There's some ways you could not do it quicker. But in this case, if you have money in your account, that's good. It's a very simple. But if your money is coming from parents, we would need a gift letter for sure. That's just saying it's a non-repayable kind of like a money. So your parents are helping you out. You're not gonna have to pay them back because they're helping you grow because you're kids. So you have to make sure not only that you have down payment available, but the source. The source of down payment is very important. We have to make sure there's no fraudulent or any money laundering going on. So you got to keep in mind. So if the money is traveling from one account to another, we are gonna need to see. Banks will need to see to make sure we can track it all the way to the source, and there's nothing fishy going on in the end. It's just something to keep in mind. So down payment is one thing, everybody knows that, but the source is very important and it explains a lot of things as well. Let's move forward. Equity. So equity, the difference between the price for which a home could be sold against the total debt registered against it. So let me expand that a little bit more. So equity is gonna be an untangible amount of money that's in the house. It usually comes down to, a lot of people after they buy the house, they make 10 years of mortgage payments, so they paid some of the principal as well. So now the principal that's being paid off, meaning the mortgage that you have paid off, you can technically have access to it when you refinance, and that money amount that you could take out is called equity. So house equity is obviously what you mortgage you paid off, and you're basically going to the bank and you're telling them, hey, I've made all these mortgage payments. I would like to get some of the equity out in cash, in whatever, to pay off some debts, however you want to use it. So that's equity. So that's a little bit different than down payment. So it's basically built over time. You could also have equity built not only because you're paying down your mortgage, but also the appreciation, right? So that's why I highly suggest, you're paying somebody else's mortgage when you're renting. Not only that he's collecting rent from you, the house is also appreciating. It's a double whammy. So if you were to buy the house, not only that rent money is going to pay off some of your principal, your mortgage, but also over time, the price of the homes that is going up right now, it's also increasing the equity as well. So you're actually saving twice than with one stone. So two birds with one stone theory right here. I also did an episode you can watch on my YouTube channel. It's called Forced Savings. It's a very similar concept where when you're taking on a mortgage commitment, that commitment is actually helping you save. So it's actually forcing you to save. Which is very good for some people. They find it very hard to save, but this is a very good way to actually save enough, obviously get some down payment and buy a house. And now not only you're making that mortgage payment, which is technically savings because you're building the equity that we just talked about, and also the appreciation. So it's double savings in the end. Moving forward, we're going to talk about something called fixed and variable mortgages. Everybody I talk to, I would say good chunk of 85% only talk about fixed. Nothing wrong with fixed mortgages. It's they're reliable, they're not fluctuating, peace of mind. Nothing's gonna happen to that payment for the next 5 years if you take a 5-year term. But just to go a little bit deeper, a fixed rate is a locked-in rate that will not increase for the term of the mortgage. So in a fixed rate, very simple, that rate is locked and it's not going to increase for that amount of time that you lock it in for. So that's also going back as a mortgage term. So if you locked in for 5 years, it's not going to change. If you locked in for 3 years, it's not going to change for 3 years. But on the opposite, a variable mortgage, the interest rate can fluctuate based on the changes of the prime rate at the lending institution. So a prime rate is basically, you can call it a base rate that the banks use, and then they're discounting that or adding to that. So if some bank guy is telling you, it's prime minus 0.05, so what they're doing is they're taking the prime at that time and they're minusing 0.05% off that at that rate to give you that rate. So in a variable, it's not really, you could say fixed, obviously. It's fluctuating. But I gotta tell you this, I would say mostly, in a variable, you're much better off. I'll tell you why. So the reason I always suggest variable is, let's say for example, if the rate does drop, you're gonna take advantage of it. In fixed, now you're stuck. Everybody else might be getting a lower rate. Now you can't break out of that term and get that lower rate. Where on the variable, if it drops, you're going to take advantage of it. But the other thing is, if the rates are rising, you could always, mostly, I would take always back and put mostly you could switch back into a fixed. So it has that little convertibility factor to it. And again, that would be explained to you when you actually sign if it has it or not. But I've seen that you have, with some institutions, the ability to switch to fixed. So it has both ways, right? And the other way is how the interest and the principal. So the principal is what's going to be obviously paying down the mortgage amount, and the interest rate is what the banks are charging you for giving you that mortgage. Is the split is a little bit different. On a variable, it's very you could say more principal interest in the first half of the mortgage than the fixed. And another thing is, usually in a variable, the break penalty is usually just 3 months interest only, where on a fixed, it's a whole different calculation, which is depending on bank to banks. I'm sure you read some in the news. The guy tried to break his mortgage. They were charging him $15,000 to break that mortgage. That's because he was in the fixed. If he had been in the variable, it would only been 3 months interest payments, which is obviously a lot for some people, but it's less than $15,000, right? So it has goods and bad of both. So at the time of signing, you have to not only plan ahead and see into the future of does locking into a 5-year really make sense or not, or a variable where it might fluctuate, but how much is it really fluctuating, right? You have to look at that fact as well. Every time the Bank of Canada does increase or decrease its rates, is usually 0.25%, so it's 0.25% every time. And and if you feel like it is going up, you could always switch into a fixed, so you can do that as well. So something to think about, something to talk about before you sign or before you pick if you need a 5-year fixed or a variable. So hopefully this helps you going in for a mortgage next time, and the guy says, okay, the 5 years fixed is this. Maybe you need to have that talk. Why 5 years? Why not variable, right? Maybe because on average, you could search this up in Canada. What I read some time ago was that 80% of the mortgages are broken within first 3 years of the 5-year term. It could be a lot of things. It could be, mismanage of money. Now they need some equity out of the house, some emergency funding they needed to do, send back home. And it could be many, many different ways, right? But because that happens, now every time you break it, now you're paying that extra penalty cost as well. So you have to think about penalty cost as well. Penalty cost as well. So that's something to think about. Let's move forward to something called a high ratio, low ratio, also known as conventional mortgage. So a high ratio, we'll talk about high ratio first. A high ratio mortgage is a mortgage loan higher than 80% of the property value. So what that means, so remember we talked about down payment, the LTV, loan to value, right? So if your loan to value, or I'll put it in a simpler terms, if you're putting less than 20% down, you are gonna be considered into a high ratio. And another thing about a high ratio is you're gonna have to pay a mortgage default insurance. It could be from Sagen, it could be from CHMC, and Home Canada Guarantee as well. So you have to pay insurance if you're going into the high ratio. But another quick fact about high ratio is because now there is a mandatory insurance that you're gonna have to take. Now the banks are very safe because they're protected by this insurance blanket that they can offer you a lower rate. So usually when you see those super low rates, they are for high ratio, meaning you're gonna have to buy the mortgage default insurance, and that mortgage default insurance protects the lender. So it doesn't protect you. So what that insurance is for, if you were to default on the mortgage, the lender is going to be safe that the insurance is going to cover the cost of the mortgage or whatever cost it might occur when it's reselling or whatever it's doing to the property after. So that's something like that. But now because it's insured, the lender can offer you a lower or lowest interest rate, but you're going to have to pay that mortgage insurance, and that's added on to your mortgage amount. So meaning if you're buying a $500,000 house and you had a $450 mortgage, on that $450 there's gonna be the insurance cost added to that, and it's all, the insurance cost is different. It's all in like a bracket format. So from here to here is this, from here to here purchase price is this. So you can't really accurately guess. There are calculators out there, but I suggest you let your mortgage professional or advisor or broker or agent help you out with that. So that's something to take note of, okay? So high ratio, yes, you can put up minimum up to 5% down on a $500,000, but you're gonna have to pay for that insurance. So there's good and bad of both. The other, obviously, the opposite is now a low ratio. So what's a low ratio? Low ratios are also, or can be called, conventional mortgage. So obviously, it's when you put down more than 20% down payment, or at 20%. So if you're putting 20% down, you don't have to get this insurance. You're qualifying for a high ratio. You're not sorry. Let me repeat that. You're not qualifying from a high ratio rate. You're qualifying for a conventional or a low ratio rate, and that rate is going to be a little bit higher. It's because now, the lender is still paying for that insurance. It's not. So let me explain a little bit more. So there is still insurance attached to it, but the lender is paying for it, and that payment is passed on to you through the interest rate. I hope that made sense. So there is insurance, the lender has their own insurance, their blanket insurance, or whoever their insurer is to insure that mortgage. But instead of charging you upfront, like on the high ratio side, it's going to be passed on to you through the interest rate. That's why on a conventional, the interest rate are a little bit higher. But I'm going to talk about this a little bit right now. I got some episodes later I want to talk about. You can't always go after the rate. Rate is one thing. Everybody's been taught to look at the rate. But if you were to think about it, are you really comfortable paying that $30,000-$40,000 up front, for insurance that, that's never might ever be exercised, meaning you might not default, right? But you still have it. Where on this side, the interest rate is a little bit higher, but you're not increasing the cost of the mortgage. So meaning the more cost of the mortgage, the more interest rate you're gonna have, right? The interest portion, you're gonna pay more interest on that, versus on the other side, if you pay 20% down, you're not paying that upfront. Now your mortgage balance is lower, meaning less interest rate. So there's good and bad of both, and I highly suggest you look kind of beyond the rate and see how that's going to help you out. We'll talk a little bit deeper, because just because the rate is low doesn't mean it's better for you. Like I hope I helped somebody out there. Just because, I'm going to say it again, the rate is low doesn't mean it's good for you. And we'll go a little bit more in depth on later episodes. So let's move forward. Now the other thing are open closed mortgages. So we got mortgage terms. So we got high ratio, low ratio / conventional, and then we got open closed mortgage terms. So I'll read the definition first. Open mortgage is a flexible mortgage that allows you to pay off your mortgage in part or full before the end of the term. Okay, so in an open mortgage, you're flexible. You can pay off the mortgage whenever you want. I'll put us in a scenario. So for example, you have some land back home. I see a lot of people that are immigrating here, and they have houses back home or ancestral land back home. So you're planning on selling that, for example, and when you sell it, you're gonna get a huge chunk of money, and it could be enough to pay off your whole mortgage. So instead of you locking yourself into a closed mortgage, which I'll explain next, you could take an open mortgage, and whenever you get that fund, you can apply it directly to the mortgage amount, the principal, and be mortgage free. But obviously the con, just like in everything, the interest rate of that mortgage is usually very, very high. It's in 5% plus, But again, look beyond the rate. Look how much flexibility you're gonna have. Look at the benefits. You're not gonna be paying out those huge penalties to break the mortgage after, right? So it's good and bad and everything. So in an open mortgage, you can basically pay off your mortgage the next day if the lender allows you. Sometimes you have to wait 6 months. Sometimes it's the next day, right? It all depends on what we sign up for and what we're really looking to do. So that's open mortgage. A closed mortgage is very, pretty much the same, but the opposite. A closed mortgage is cannot be paid off at random. You might have some prepayment privileges. So basically, we'll talk about prepayment. So prepayment, a lender will allow you a certain percentage of paying directly to your principal without any penalties. So for example, if your prepayment is 15-15, meaning you could every year you could put down up to 15% of the mortgage amount directly to your principal, and that's technically paying off your mortgage faster. But if you look in general, let's say you want to pay 80%. You have 80% of the mortgage amount money sitting. Now you want to put it down, you won't be able to do that. You'd be incurring penalties. So in a closed mortgage, you don't have that flexibility. But if you need it, then open. If you don't need that flexibility, you don't have any huge sum of money coming, it's very safe to go with closed. Now you know the both. And again, this is a talk you want to have with your mortgage agent, mortgage professional, mortgage broker, to kind of help you, guide you. So you have to take both in account for. Let's move forward. We're pretty much in the end. I want to talk about one more thing. I'm going to talk about prepayment a little bit more. In prepayments, you could actually not have them. So what that means, so in some cases, you could get these basic no-frill mortgages, and those mortgages are no-feature mortgages. It's just a basic mortgage. Because it's just a basic mortgage, you're going to get that aggressive low rate. Right? Again, I want to help you. I'm technically helping you. I'm really watching out for you right now. Is don't go after the rate. Go after what you're actually getting for that rate. So in a very low rate environment, you might not have any prepayment privileges, right? You might not have any acceleration of payment privileges, right? You might even have a bona fide sales clause. So that basically, a bona fide sale clause is if you take a 5-year term, the lender's like, okay, the bank's gonna be like, okay, I'll give you this super low rate, but the only way you can break this mortgage is if you sell the house. Now, does that low mortgager really make sense? Think about that. Maybe what if there's an emergency? Now you have to get some equity out of the house. What, you're not gonna have to sell the house to get the equity back that you put in yourself? But you know what? But you wanted the lowest interest rate. So that's a conversation you have to have 100%. Not only you need to look at what the rate is, but what the rate is getting you, right? I highly suggest you at least do accelerated bi-weekly payments. By accelerating your payments, you're gonna be paying 2 to 4 extra mortgage payments. Sorry, in the span of the time. And that's really gonna shave off some years off your total mortgage amortization, just because you're making those extra 2 to 4 payments per year. And just like everything adds up in the end. Well, that's all I have to say today. I hope you guys really enjoyed our conversation. It was very uncanned. It was really, me talking to you guys and explaining what the terms are. So hopefully you are ready to go in the in the real estate world, buy a house. But I want to say one more thing before I end this episode and get ready for the next one. Is you have to have your finances before going to look for a house. A lot of people make a mistake. They're going for the house before the money. You need the money, meaning a mortgage, before the house. That's not only because you're gonna know what your maximum purchase price is, but also you're gonna have time to think about what you really wanna do in terms of a mortgage. Do you really want these basic no-frill, low-rate mortgage product? Do you want to maybe save up for a 20% down? and not go after the 5%. A lot of, I'll say this now, if a lot of you guys are self-employed, we know for a fact that, self-employed people are making a lot of money. They have income that's coming in, but their smart accountant is really, I want to say, working the numbers in benefit of saving him in taxes in the end. But now, if you're doing that, we can't really get you on those lower rate sides, so you're better off saving for 20%. Because if you're, let's say for example, if you're making $100,000, but after all your taxes are done, and the expenses are made and accounted for, you're only making 30 or claiming 30. Now we can only use 30 on the 20% below side. So if you maybe I'll explain a little bit more in a different way. So because now you're only showing 30, now the only way you could get away with the 5%, the 10%, anything below 20% down is if we were to only use 30. Even though you might be making $100,000, you could show us in your bank statements and all that. But in this criteria, we would have to go what the taxes are saying, and that's it. But if you still want to get a mortgage, we can still get you a mortgage, but we would be very closely looking at minimum 20% down, just so we could kind of get out of the prime side and look at the other side, and help you qualify that. And again, everything is not always the case. These are very generalization. These are very assumptions that we are making, just because I don't know who I'm talking to or how many people we are talking to, and their background, their situation, their debt level, their credit level. So we have to, I have to keep that in mind. So I'm telling you, there is a mortgage for a lot of you guys out there that might think you can't get a mortgage. That's where you can give us a call. Give me a call. My number is always in the description, and let's sit down and talk. Right? Nothing is ever gonna hurt. It's only good is gonna come out. If anything, we love to educate you. Talk beyond the rate. I really love this line, beyond the rate. We really need to talk beyond the rate, because rate is not everything. I'm telling you, if you're stuck on rate, then you're missing out on the whole other chunk of the pie. And I would literally say the other 70% of the pie you're missing out on. You'll get that piece, but you're missing out on the other 70%. So we gotta look and talk beyond the rate. And this was the episode number 3. I hope you guys really enjoyed it. I enjoyed it. I really love talking to you guys. If I don't see you before Christmas, Merry Christmas. If I do see you before Christmas, I'm gonna still say it right now. Merry Christmas, and I wish you guys the best. I really hope I helped you guys out. Stay tuned, like, subscribe, share the video for any new immigrants, new home buyer, anybody looking to buy a house. You're really gonna help them out. It could literally be used as a Christmas gift, the way I see it. You're gonna give them an opportunity to actually do a home ownership. And I always tell every single client that I meet, buying a home is a generational wealth. It's gonna be passed on to you in generations. You're gonna pass it on to your kid. It might not be the same house, but you're gonna sell the house, take the money, and buy another one, and that's gonna be his. So these are long-term goals. If you're renting right now, let's talk. There's ways we can help you out to save for a down payment. There's government programs out there to help you with down payments. So we have a lot of options. I think the best way to start is to give us a call, and we can do it. And let's talk. And I hope you guys have an amazing day. Take care. This is Manny Yassi. Goodbye.